Okay, guys, so let's do a Fed preview. The final big moment of 2016. So we'll have a 7 p.m. Statement and rate decision delivered to the world. And then at 7:30, Yellen will have a live press conference where she will firstly read out the statement. And then obviously we'll know what that statement contains already. So the press conference is, of course, more about the Q&A session and just trying to get a general vibe off the Fed chair herself as to what, as to how she sees things. So this is, we're coming into 4 p.m. almost. So we've just got over 3 hours now before the event kicks off. Just for now, I'm just watching oil actually. I mean, it's been a quiet, subdued-ish session as we wait. I mean, oil's now just punched up towards the pivot level. I was talking about this in the briefing this morning. We had a little foray down into the gap, but that support level that came from the summer earlier on in the year, nicely containing the downside. Then we've popped higher off the bullish inventory data, of course. Other than oil on the move, we've had also, just to kind of assess the vibe here as we go into Yellen and the Fed statement, we've had T-notes pop up and make a move above yesterday's high point, and that's off the back of the slightly weak retail sales data. So we got T-notes on the up when you're looking at this 1 hour chart, but of course if you go to a daily chart, the word up is not a word that's going to spring to mind because we've collapsed. It's been one of the biggest sell-offs we've seen for a long time. So T-notes driving lower, and of course the dollar driving higher in the medium term. We have seen the dollar pull off a little bit today. Again, the kind of weak retail sales figures perhaps to blame for that. Really, the euro dollar looking up at the top end of the range of the last few sessions, or the last couple of sessions. But of course, like T-notes, euro dollar is also down through the floor in the main. Obviously a lot of volatility off the likes of the ECB and so on, but in the end, here we are going into the Fed decision, and we're pretty much where we were a month ago, back mid-November, and that was off the back of the big move to the downside as we got a general phase of dollar strength. So dollar strength, T-note weakness, they're the kind of two lead indicators of how expectations have changed with regards to what the Fed are going to do in 2017. And expectations have risen with regards to, well, let's say expectations are that the rate hiking trajectory is going to be steeper, and that's off the back of the idea that Trump's fiscal stimulus program is going to drive faster growth. It's going to drive more demand for goods and higher inflation, and the Fed are going to have to act and be more hawkish if they want to contain the inflation upside. So this has been reflected in markets really ever since the Trump election win. So we've had 5 weeks of pricing in a more hawkish Fed. And I would say also, of course, pricing in the fact we're going to get a hike today. So let's just flick across to a different screenshot. I showed you a couple of these charts already this morning in the market briefing, but worth going over again. The bottom of this chart nicely indicates what I've just spoken about. The dollar has strengthened, T-notes have sold off in anticipation that the Fed are going to be more hawkish next year, and in anticipation of the Fed hiking today. And if you look at the probability of a Fed rate hike today, it is 100%, and we're expecting that the Fed are going to raise rates by 0.25%. Here is a look at the Fed rates over the last 25, 26 years, and here we are down here, and the Fed have a range. Their interest rate, well, here it says it's 0.5%. I mean, technically it's actually in a range between 0.25% to 0.5%. The upper bound is 0.5%, and we're expecting the range to be shifted up by 25 basis points, or 0.25%. So we're expecting the range to become rates being between 0.5% up to 0.75%. So the upper bound will move from 0.5 to 0.75. And this will be the second rate hike of the last decade, because you've really got to go back to the summer of 2006. That's when we had the end of the last rate hiking cycle. Since then, of course, carnage, zero interest rates for more than 7 years, one hike. So, just get this in perspective. We are at a record ever low still. The Fed are going to hike rates today, but in the grand scheme of things, we are still at a record ever low. I spoke about the fact the dollar has strengthened and that T-notes have sold off as yields have risen. And then, of course, on the equity front, we've seen huge movement to the upside. And this is, despite the fact, if you go back over the last few years, well then a hawkish Fed is bad news for equities. So you're looking at a chart like this, which is showing the Dow Jones having climbed to a new all-time high since the election. Of course, this doesn't make sense when you're just thinking about the Fed, because the Fed are now considered to be much more hawkish than they were. But it's not negative for equities here. It's been positive, and that's because the more significant influence on stocks here is the fact that it's going to drive much stronger growth. Plus, if finally this 30-year bond market rally is over, and the sell-off we've seen in bonds in the last 5 weeks is just the beginning, well then we've seen a big rotation of assets here as money's come out of bonds and into equities. So just be aware as we go into tonight, just be aware of what's been happening in the medium term, okay? You've had big dollar strength, big equity strength, and you've had big downside for bonds, all right? So just remember that when we go into tonight. The biggest event tonight, which unfortunately isn't going to happen, but the biggest event from a trading point of view is if the Fed did not hike. If they chose to remain on hold, that would be an epic-sized market event, and you would get a big reversal of all of the moves we've seen over the 5-week period. You'd get the dollar weakening dramatically. You'd get bonds rallying hard, and you'd get equities, well, on the argument I've just mapped out, you should get equities selling off, okay? But of course that's incredibly unlikely to happen. So let's just talk about realistic outcomes. And so really it's all about they're hiking, and then it's just whether, what's the accompanying language, what is the forward guidance for next year. And so we kind of got 3 scenarios that this kind of gets simplified into. And this is nicely summed up here on this table. And if you look at the 3 columns, these are really the 3 potential outcomes tonight, because we're going to get a hike. So then it's just depending on the language. Do we get an interest rate hike plus hawkish language? The Fed really...
JP Morgan downgrade their US Q4 GDP forecast.
Sorry. The Fed using the dot plot matrix to raise the average year-end dot over the next 3 years. So let me just explain that in a better way. I mean, if I show you the dot plot, in fact, let me just find my dot plot chart. 1 second. It's here somewhere. Here we go. So they'll probably use the dot plot. Let me just try and make that a bit bigger. They'll use the dot plot to communicate their forward guidance. So if they hike rates, and let's say the median dot for 2017 increases, at the moment, if you look at the September dots, that's the green ones. Of course, they were revised down from the June dots. So we had a dovish move on the dot plot matrix in September. Are we now going to get a hawkish move in December? At the moment, according to the dot plot, the Fed expect to hike. I mean, that's the Fed themselves expect to hike rates twice next year. There's a chance that this goes to 3 times. And in fact, if you check out what Goldman's think about this, Goldman Sachs are saying that they expect the Fed, and if you have a look at the chart on the left, let me make that a little bigger as well. This is where Goldman Sachs's line, this is where they think the rate trajectory is going to be over the next 3 years. And the bluish, or whatever color that is underneath it, that's the Fed's Fed futures implied rate hikes, okay? So Goldman's think that the Fed will hike 3 times next year. How do I know that? By this chart. That's because the Goldman's dot, their plot for the end of 2017 is at 1.5%. So if they hike today, they're going to hike to 0.75. If we're going to have rates at 1.5% by the end of 2017, well, that means 3 hikes, because unless something phenomenally extraordinary happens, the Fed are only going to move rates by 0.25% increments on the way up. Okay? How do we know that? Well, that's what experience tells us. Look at the last rate hiking cycle. This began in June 2004, and the cycle ended in July 2006. And look at the staircase here. They increased rates from 1% to 5.25%. Every single move was 0.25% increment. Okay, so I mean the cycle before that, back in the mid-90s, well, sure, okay, they stepped up rates by larger amounts, and indeed we got a 0.75% hike in November 1994. This is when inflation was a little bit more volatile. Because we're not expecting inflation to be particularly rampant, then we're definitely expecting the Fed to go up 0.25% per hike. So if Goldman's think rates will be at 1.5% at the end of next year, that means they think there's going to be 3 hikes. This, I think, mainly in terms of how markets are going to react here, it's really going to be about that. What does the dot plot say about the number of hikes next year? If I go back to those 3 columns, where are they? Here. The hawkish hike is really if they hike interest rates plus the dot plot gets revised up. So your end of 2017 means that we've got 3 hikes next year. Plus you're probably also going to need a hawkish change to the text in the statement. I'll talk about the statement in a minute. A neutral hike, this will be where they hike rates, but maybe the 2017 dot does go up to 3 hikes, but then the text in the statement doesn't turn more hawkish. And then you've got your dovish hike scenario. This is where they hike, but the dot doesn't move, and the 2017 dot remains at 2 hikes. That's your dovish scenario, and the Fed statement reflects that by remaining relatively unchanged. Okay, it's all very, very subtle, these changes, but it's really, so let me just repeat that. A hawkish hike is if the dot plot matrix shows 3 hikes in 2017, plus we get hawkish changes to the statement. The opposite, the dovish hike, that's if we get a hike but the dot doesn't change, it's only 2 hikes next year and the statement language remains the same. Neutral is if you get the dot moving up but actually language in the statement remains unchanged. Okay, so these are your 3 scenarios. You've got a matrix here showing how Deutsche think markets are going to react in the event of each one. Okay, we'll come back to that in a sec. Let me show you this statement, and let me show you what the press get. At 7 o'clock, well actually, at 6:30 p.m, the Fed are in their lockup. The journalists, the designated journalists, are in the lockup, and they get this statement at 6:30. This is like a 500-word document. This is the summary of the 2-day meeting, okay, and it contains, well, normally only very subtle changes to the meeting before. Now on this statement I'm showing you here, this was the statement from their last meeting, but it's showing and tracking the changes compared to the meeting before that. So you can see what I mean about virtually no changes. I mean, there literally is virtually, you get a few words here or there being changed. For example, in November, the Fed said that although the unemployment rate is little changed in recent months, job gains have been solid. Household spending has been rising moderately. They had said household spending has been growing strong. Then they changed that to rising moderately, which is a bit of a dovish change. In terms of inflation, inflation has increased somewhat since earlier this year, but is still below the committee's 2% target. They had said inflation has continued to run below. So actually that was a slightly hawkish change to the statement. So you've got to understand that this is not clear cut. You have to understand that this statement is going to be changed, and there's most likely going to be contradictions where they're going to change some sentences and make them more hawkish, and then they're going to perhaps alter other sentences and make them more dovish, which is why trading a Fed event, or trading any monetary policy event, is not straightforward. So this is what the press get at 6:30. They also get this thing, which is essentially the dot plot matrix, but it's actually more than that. So you see the Fed funds rates down here at the bottom. This is their kind of guidance. And look at the big change in September was looking at the 2017 median dot, because the June dot plot had rates at the end of 2017 at 1.6%. But in September, they revised that down by a massive half a percent and chopped it to 1.1. This was a very dovish change in the dot plot. What we're expecting is this 1.1% to move back up. Okay. So this is what the journalists get. Do bear in mind, we're also going to get revisions to the Fed's forecasts for next year and the year after, and indeed the year after that. So we're going to get 2017, 2018 and 2019 GDP and inflation forecast changes. So these are important as well. And I think it's difficult for the Fed. I think markets generally tend to over expect from the Fed. They expect that the Fed are going to deliver more than they actually end up doing. I think if I was Yellen, if I was sat on the Fed committee, you don't want to be making any bold, major forecast changes for 2017 when the uncertainty is so high. I mean, Trump is going to arrive in the White House in end of January, and I mean, who the hell knows what's going to happen? Now, markets are quite bullish about it, but what do markets know? We've got a fiscal program that's going to be delivered, but how big is it going to be and how effective is it going to be? It's hard to say. So, from the Fed's point of view, they don't want to be making any bold, crazy forecasts here, only to then end up being wrong and looking pretty foolish. So most likely the Fed are going to want to play a waiting game in 2017. Yellen's most likely going to use her press conference to talk about this. I don't think you're going to get much mention of the Trump factor in the statement. I think Yellen will use the press conference to just paint that picture that, look, how can you possibly expect us to make any clear-cut decisions on forecasts? We're going to have to wait and see. That'll be her angle. So what most likely is going to happen tonight, which is quite a typical scenario for a Fed event, is the statement will get released at 7. They'll hike rates. We'll get the dot plot matrix. I would say you're most likely going to get a slightly hawkish reaction, and then I think that Yellen in the press conference is going to counter that and be slightly dovish. Net, perhaps we'll wind up, without any kind of clear-cut new information. In the end, if anything, my prediction would be that this, in the end, will be slightly dovish. I think you'll probably get a neutral hike with maybe the chance of a dovish hike. That's my personal view. Anyway, this is quite a good insight into what the journalists get. What you then have to understand is, how do you get the news as a trader? Well, here this is where Bloomberg come into play, or the likes of Bloomberg and Reuters and so on. And what the journalists at Bloomberg do is they take this information that they get at 6:30, so this table of numbers plus the Fed's statement, and what they do is essentially create a series of headlines to summarize all this information. Now, there might be, I don't know, anywhere up to like 10 headlines, okay? But the way the Bloomberg terminal works, they tend to have what are called two sticky headlines. That means that they're two headlines that always stay at the top of the news feed. You then get new headlines coming down, but the two sticky ones are always at the top. So the reason why I'm telling you this is because the journalist at Bloomberg, that journalist is the one who decides what information to put in the two top headlines. So actually, in terms of initial market reaction, it's actually driven by what this one journalist thinks is the most important. And unfortunately, journalists tend to like the sensational elements of a set of information. And you can quite often see Bloomberg picking out the one hawkish part of the statement and having that up there as the sticky headline, and you can't summarize all of this stuff in one or two headlines. So you can often see the initial reaction being one directional, let's say it's a hawkish move, but then you can often see that getting reversed in the minutes that follow when people sift through the statement themselves, because this statement is available straight away after 7 o'clock. And this statement tracker that I'm showing you here on this website is a fantastic tool, and it very quickly shows you what changes have been made, and then investors can make up their own decisions as to what's important, rather than initially you having to rely on this Bloomberg journalist. Okay, so do always remember that you're going to get volatility in this event. We're going to get hawkish news flow, we're going to get dovish, you're going to get movement both ways. Where markets end up, let's say at the close tonight, will not be based on that one Bloomberg journalist's idea of what's important. It will be based on all the information. It will be based on also then what Janet Yellen says. For what it's worth, perhaps the most important poll in finance is the Amplify Trading Twitter poll. And here we are with a phenomenal sample range of 18 votes. Guys, that's disappointing. Can you, if you're listening to me, can you get on our Twitter feed and vote, please? Do you think we're going to get a dovish hike? Do you think we're going to get a neutral hike? Do you think we're going to get a hawkish hike? Well, I don't know who the 17% are. But apparently we got, what's that, 3 people? We got 3 people who think there's going to be no hike. Good luck with that. So let's just sort of look at markets. Normally, when I'm trading a monetary policy event, normally I'll stick to bonds and currencies. Normally that's where you get the clear-cut unidirectional moves. For equities in the past, trading a monetary policy event's tricky, because I remember I mentioned a minute ago that in the past, if the Fed's hawkish, well then that's bad news for equities and equities sell off. But why are the Fed hawkish? Well, they might increase their growth forecasts, but you might say, well, hang on, that's good news because the economy is going to grow faster. So there was always this contradiction for equities. This is where the good news is bad news terminology comes from. It's where the Fed say growth's going to be a lot faster, so that's good news, right? But then that means the Fed are going to hike rates faster, and actually that's bad news for equities. But you tend to get a mess. So that's why normally I would focus on looking at, in the Fed event scenario, looking at trading the dollar or T-notes. However, I would say today the equity asset class is not a bad bet either. I think we've gone away from this good news is bad news, because actually good news looks like it's good news. If anybody's just tuned into this briefing and listened to that last comment, I haven't gone mad. Good news is good news, people. Look, equities through the roof to all-time highs off the back of the fact that we're going to get stronger growth. Good news is good news, and equities move up. So therefore, bad news, well, that's going to be bad news. Bad news would be if the Fed don't hike, would be the dramatic event. That means, well, hang on, they don't think growth is going to increase. All right, maybe we're wrong. Let's sell equities. So I think dovish Fed, you get equities sell off. Hawkish Fed, you get equities rally, perhaps, which is the first Fed meeting I've said that at for, I mean, I don't know how long. Probably a decade, I would say. So we literally, this is for equities, this is a new dawn with regards to how it behaves relative to the Fed, in my opinion. So we may well get some decent one-directional moves and less contradiction. But having said that, T-notes and the dollar are still going to be very key markets to be looking at. And as I said, we've sold off here over the last few weeks, where I would say we are priced. Personally, my opinion is these markets, when you look at T-notes and the dollar, well, and indeed equities, we are priced for a slightly hawkish hike. I think we're priced for a hike today, plus the Fed to upgrade their growth and inflation forecasts, and therefore the Fed to tweak higher their dot plot matrix. I think these markets are positioned for a slightly hawkish hike. So if we get a neutral hike, I think there's going to be slight upside for T-notes as some of this movement's reversed. If you get a neutral hike, you might get the dollar selling off a little bit. If you get a dovish hike, well then, right, I think this is good news for traders because we can get some movement. I would say the dovish side of the hike spectrum is perhaps the one that people are least expecting, if that makes sense. So if we have a dovish hike, well then fine. T-notes can continue the move that we've already seen today off the back of that retail sales data. We jumped up through yesterday's high. And T-notes, if we get a dovish hike, can start pushing up and looking at testing some of these kind of wave tops from earlier in the month. So let's say that when was that? Friday's high at 124.18, and then you're looking at the high point that we had back on Thursday, which is 124.28, and so on. Okay, so certainly 124.28 is quite an interesting price point, and certainly reachable off a dovish hike. Of course, we could get a really hawkish hike. I think this is the least likely, and that's because I've been watching Yellen and the Fed for many years, and if there's any hint of doubt, then they'll prefer to remain cautious and non-committal. So I think it's very unlikely you're going to get the Fed come out and really be hawkish with their hike here. But if they were, then T-notes fine. The move we've seen higher today will be invalidated, and we'll track back and have a look at testing the low point that we had at the beginning of the week. 123.16 and a half is a decent sized move. We can definitely get down there off a hawkish hike. The dollar, I mean, where's my, let's have a look, like the euro dollar chart, for example. Again, similar to T-notes, we're right down here, priced for I would say mildly hawkish hike. If we get a dovish hike, well fine, we move higher. I mean, we've obviously had a lot of volatility this month already. A hugely important price for the December futures is 108.78, which is the spike high we had off Draghi last week, plus it's the key low from October. 108.78, hugely important. I actually probably think that's too far away for today's meeting. 108, the 108 handle's interesting. That was the high on the 5th of December. So off a dovish hike, maybe that 108 handles an outside target. On the downside, of course, much easier, the low of the year, 105.10. And we can get down there for sure off a hawkish hike. Okay, so this is what I'm thinking about. It's just they're going to hike. It's just whether it's a hawkish, a neutral, or a dovish. Just final point, just to reiterate, how will we know if it's a hawkish, neutral, or dovish hike? Let me just reiterate this. It's easier to talk about the dot plot first. Just to reiterate, a hawkish hike is if they hike rates and the median dot plots move higher, and so the Fed communicate they're going to hike rates most likely 3 times next year, not twice. Okay, that's hawkish. Dovish would be if they don't change their dots and the trajectory remains unchanged. That would be dovish. Okay. With regards to the Fed's statement, it's looking for subtle changes to the text. Now, I can't tell you what the changes are going to be here. This is why it's quite tricky, if you haven't traded an event like this before, to try and figure out changes in language, and is that hawkish or is it dovish. But any kind of language that shifts higher inflation expectations, then that's hawkish. Okay? If the inflation comments remain unchanged and they do not change their statement about inflation, that's dovish, because the Trump event has led market participants to revise higher our inflation expectations for next year. If the Fed leave their statement unchanged with regards to their description of inflation, then that's dovish compared to what we think. There might be there's a couple of words to look out for. Gradual. I've highlighted the word here on the statement. In November they said, the committee expects that with gradual adjustments in the stance of monetary policy, economic activity will expand at a moderate pace, blah, blah, blah. If they want to be more hawkish, they might remove the word gradual. Okay? That would imply that they're going to raise rates faster. So that's something that people are looking out for. Are they going to drop gradual or not? I think it's very unlikely, but some think it might happen. The other thing is time. If I scroll down, and this is an important one, I'm going to highlight this comment here. Let me just read the sentence. The committee expects that economic conditions will evolve in a manner that will warrant only gradual increases in the federal funds rate. The federal funds rate is likely to remain for some time below levels that are expected to prevail in the longer run. They might ditch those 3 words. If 3 words are deleted, and those 3 words happen to be for some time, well, that's hawkish. That's implying that they're not going to keep rates low for long, and they're going to actually start to raise rates faster. So hopefully that gives you a bit of an insight into the real subtleties of how this statement might get changed, and this is where it gets tricky to try and judge it in real time. So yeah, I would say the most important sentence in the whole statement is that one I've just highlighted, because it talks about gradual increases, it talks about rates remaining below normal levels for some time. All right, that is the one sentence you should be concentrating on. So remember that no change to the statement is dovish. Changes I've just described would be hawkish. Okay? So there we are. This will be mostly a 7 p.m. event with potential other movements driven off Yellen's comments that really come after 7:30. At 7 p.m. we get the rate decision. We also get the revised dot plot matrix. We also get the full statement, and you get all the headlines coming out on the news feeds. All right, so that's the 7 p.m. That's the big moment. Then at 7:30, Yellen will start her press conference. The beginning part of it is her reading out the statement that we already know about. So really, it's then the Q&A session that follows that. So really, you're looking at kind of 7:45, let's say through to 8 p.m. as the key window where you might get something extra in terms of guidance for next year off the chair herself. Okay, so that rounds up the briefing ahead of tonight, the last big event of the year. All right, good luck. Thanks.